Welcome back to the stock portfolio update videos. Currently, my two stock portfolios sit at a combined value of over $71,000. That's made up of the $44,370 in my stake position and the $26,727 in my Vanguard portfolio. Having a quick breakdown through my stake portfolio, you can see none of my major holdings have changed, but I did invest another $2,000 into Amazon, which I'll cover in this video as well. Overall, it's been a rough time in the market, as if anyone who's been investing has seen. Even just the casual investors or people who don't invest have probably heard the news on the markets and how they've been trading down. And just this week alone, the S&P is down over 4.7%, and in the last month it's down around 6%, which doesn't sound that bad, but there was a lot of market volatility, and I'll cover a bit more on that with a few articles I wanted to dive into. First of all, I just wanted to have a quick look at my portfolio and see how everything's been going. You can see my total gains in my stake portfolio is now down to 24,000, which was previously even at one point in like 34%. So it's had a bit of a drop down now, as a lot of my portfolios were heavily hit with the market pullback, with a lot of my portfolio being heavily weighted to tech, which is actually something I want to move away from. Even with my recent investment, I am still looking to pivot into diversifying this portfolio a bit more. I've gotten a bit slack in terms of my VOO position. It's now sitting at around 46% of the portfolio's value, and I need to boost that back up to 50%. Overall, I did quickly mention that I did invest a decent chunk of money into Amazon. I now own 8.3226 shares, and I'm pretty much flat on my position. The reason why is because Amazon was actually a stock I was looking at buying into a while ago. If you've seen any of my older videos, when I decided to invest in Microsoft and kind of double down on that position, Amazon was a stock I was kind of 50-50 on. And recently it's had a rough week, down 12.2%. And in the last month, it's down 19%. Even in the last 6 months, it's down, and in the last year, it's only up 13%, especially when you compare it to the overall market. It's had a not the best year. Even the last 5 years for Amazon, it's still up 80%, but it's been very volatile in terms of ups and downs, such as if you were buying in start of 2023, back into 2022, you would have got some great gains from the stock. Overall, you can have a quick look through. Again, this is just analysts' expectations, but you can see a lot of people are saying to buy this stock. And when I go through the earnings in a little bit, you'll understand my kind of thoughts on why I didn't think they were as negative as it might have seemed. And I think Amazon was probably a victim of the overall sell-off. Having a look through at the Amazon report, so it says Amazon shares tumble after third quarter outlook disappoints. Amazon shares tumbled on Friday, a day after the company reported a revenue miss and disappointing guidance for the second quarter. The company is navigating slower sales in a core retail business and said the chaotic news cycle was partly to blame for the weak forecast. Despite the mixed quarter, analysts were encouraged by the continuing strength in the Amazon Cloud unit. Amazon shares closed down around 8.7% on Friday, a day after the company reported its mixed second quarter earnings and gave forecasts for the third quarter that fell short of Wall Street's expectations. Revenue in the second quarter rose 10% from the year earlier to $147.98 billion, falling just short of the $148.56 billion projected. That's what I was talking about, where that's the big thing, where a lot of these stocks do pull back over these minor misses. I mean, you're talking about $147 billion in revenue, and people are upset they didn't make an extra 0.6%, or an extra 0.6, sorry. And it's had such a big pullback. The net income at Amazon nearly doubled from the year earlier to 1.2 a share, topping the analyst expectations of 1.03. Again, another big blow out of the park, a great result for Amazon, but that's not reflected in the share price. And providing the latest evidence that the company's focus on cost cutting is bolstering its bottom line. For the third quarter, which runs through September, Amazon said it expects revenue of $154 billion to $158.5 billion, and the midpoint range of $156.25 billion, which was short of, again, the consensus. The company saw a softer than anticipated sales because consumers continued to trade down to lower ticket items such as everyday essentials and consumables, or items that tend to be cheaper and are used more on a regular basis. What's more, a chaotic news cycle means the consumers are more distracted than usual and may wait to purchase or abandon their cart altogether, is what the CFO said. Overall, going through this, we also mentioned about the strength of their cloud unit. It was not as much highlighted here, but you can see that Amazon didn't actually have the worst earnings ever. You can go have a bigger in-depth look if you want. I'm not going to cover too in-depth on just this short video, but the stock took a massive hit, as I mentioned in the last week. And I kind of saw this as a buying opportunity. I used to hold Amazon stock a long time ago. I sold out of it, put it elsewhere, did all right. But it was still a stock I kept my eye on because I still believe in the company long term. And again, they print money, this company. Like I said, they're improving their bottom line, and as a shareholder, that's exactly what you want to hear. And I thought I could buy it in at a discount right now, especially when I looked at other positions in the market. So that's my investment into Amazon. It was around 2,000 AUD. It's taken my total equity to 1,335, and it's around 5% of my stake portfolio's value. Having another look again through the holdings, like I said, my next investment into this portfolio will be into VOO. Hopefully get it up to 30 shares as I push to get it back up to 50%. I've kind of got a little bit slack in terms of my weighting of my different portfolio positions. Like you can see, Microsoft's nearly 20% now, and some of my other positions, which I really believe in, like Costco, has fallen all the way to 6% just because of how high the stock price got. But I will be addressing this and hopefully be allocating funds and moving them around to help sort this out. Another position I wanted to highlight was McDonald's. It's a stock that's had a really good month, up 7%, and even the last week is up 2%. This was a stock I've had a little bit of ups and downs with. I bought it at a really good price here. Was thinking of selling it here, didn't sell it. I could have easily locked in a 13% gain in a short term and moved those funds elsewhere. Decided to hold it, went through this downturn, and it's had its earnings recently, and it's kind of bounced back up. So again, McDonald's is a stock I believe in long term. It's a company I believe in long term. I don't see it going anywhere. If I was to close this portfolio, never look at it again for 5-10 years, I think McDonald's will still be out there operating and still be generating shareholder value. The other portfolio I wanted to go through is my VOO Vanguard portfolio, which I will be putting more money into today, and that has had a pullback as well. Last month I was in the 27,000s. It's now down to the 26s. So I'll be investing a bit of money today when my paycheck comes in into this portfolio, more than likely in VGS, maybe even VLC, I'll decide. And that will hopefully push this right back up over $27,000 again, maybe even close to 28, which will be good. Hopefully I can keep buying into stocks at these cheaper prices so I can grow my overall portfolio positions and get bigger dividends and hopefully bigger gains. I did also want to cover quickly what has been going on in the markets. I'm sure if you've, like I said, been investing, or even if you're not, you would have heard a bunch of the news about what's happening, not just in Australia, but globally. And I just wanted to go through this article as well. So it's been a wild couple of days in Australia and the global share market. Huge falls in the ASX on Friday and Monday, as well as Wall Street, may have made investors and those with superannuation funds tied to the stock market nervous. But the share market experienced its worst 2 days of trading since 2020. The index closed higher on Tuesday. So why is the ASX all over the place, and what does this mean for investors, and how will this continue to play out? There are some of the more pressing questions which they cover, but what's actually causing the volatility? Just a handful of stocks ruled proceedings in the race for artificial intelligence dominance, and the previous tech boom, the dot-com boom 25 years ago, saw hundreds of hopeful raises cash from hapless investors and blow it on loss-making ventures. Only a couple survived, and some are now battling it out in AI. However, the difference is this time, while these companies are hugely profitable and can afford to blow billions, they have also been priced for glory. Big investors have smelt the sizzle and want to see the steak, is what they say. They're pretty much just using it as an example for, as they mention here, the Magnificent Seven, which is Amazon, Apple, Alphabet, Microsoft, Meta, Nvidia, and Tesla. They've all been overcooked, is pretty much what they're saying. If you've heard a lot of, whether it was other forms of content, a lot of people say the Magnificent Seven is the only thing that's been holding up the actual S&P. Because of how the weighting works, as these positions continue to grow, they continue to take up a bigger percentage of the S&P 500. So whilst it's still 500 stocks, they just become weighted heavier and heavier. And that's one of the bad things about my portfolio, I'd say as well, is I'm so heavily weighted into tech. Even when I keep buying into the S&P 500, the big tech positions are such a big factor in the S&P 500 that whilst you're getting diversification, you're still getting a lot of exposure into big tech. So what it's saying is altogether those companies shared around 800 billion during the trading on Wall Street on Monday night, as fears Americans' recession could be around the corner. It's worth pointing out that these companies have gone from strength to strength on the markets recently, and Apple, Nvidia, and Microsoft have all been jostling for the title of the most valuable company on Wall Street. Also, if you've been following, you might have seen the Asian markets and Japan in particular, what's been happening with them. I'm going to cover as well the carry trade, kind of what that is and what's been happening. But whilst you can't point the finger at one influence, Japan is playing a role in its market reduction right now. And if you've heard a lot about stagflation, Japan is kind of the prime example of that. They've been going through a bit of a rough time, and there's a reason why the yen is so weak, and people always say to travel there, and that's one of the reasons why. What this kind of means for investors here, and even the everyday Australians or everyday investors, is what they don't realize is their superannuation or retirement funds, pensions, things like that, are all invested into stocks, or they'll have a percentage of their investments in stocks. And with this market turned down, it means everyone is actually affected by it. So it's a good thing to probably not look at your investments right now, or look at your super. If you're going to make a spur of the moment decision, that typically doesn't end up being the best. But this isn't financial advice, obviously. Do what you think's best. But just take a good think before you do, is all I'd say. And I did want to cover the carry trade, which is unwinding, which I actually found quite interesting myself, kind of when I was learning about this, because it wasn't something I was too aware of. But it's got to do with a lot of people borrowing from Japan, or you'll see this. The rapid interest rate cuts from the Federal Reserve could make matters worse for the global carry trade unwind, according to economists. The warning comes as market participants seek to aggressively roll back on carry trades following a dramatic global sell-off in risk assets. Carry trades refer to the operations where an investor borrows in a currency with a lower interest rate, such as the Japanese yen, and reinvests the proceeds in a high-yielding asset somewhere else. The trading strategy has been hugely popular in recent years. Stock markets in Europe were unsettled in Tuesday, pairing gains earlier amid a false sense of relief. An August stock slump has partially been driven by the weaker-than-expected US economic data at the end of last week. The reading led investors to worry that the Federal Reserve may be behind the curve in cutting interest rates to fend off a recession. The natural recession from the Fed to soft labor markets data and fresh recession risks would be to cut rates and to do so relatively rapidly, but this would exacerbate any carry trade unwinds. The US economy should trump all else, and it would make sense for the central bankers to be cautious. So pretty much what they're saying is that obviously if Japan, they lift their rates and kind of get out of their stagflation, and US drops their rates, it's going to affect a lot of those people who have a lot of exposure, and all of these banks and institutions who are doing these trades where they're borrowing in yen to invest in another country just to pick up whatever that difference is in the rates and hopefully see that as free money. But they're going to get affected now. And this has been going on for a little while now, I think a few weeks. So it's not nothing new, but I think it's just getting a lot more coverage now. Especially if you were invested in risky assets and the value of those assets have dropped and you were doing these carry trades. It's probably not looking the best for you now. And I'm sure the risk management teams at a lot of these places are probably trying to sort this out to ensure they're not losing too much money potentially. That's why I always find it interesting when people work on margin and things like that, and then they risk getting a margin call. It's not something I would do, but obviously you can do whatever you'd like with your investments. And one of the last topics I also wanted to cover was Airbnb. So Airbnb shares dropped 14% on earnings miss. So this was a big drop and a big miss. The vacation rental company warned that the expected moderation of a 1 year-over-year growth in its key nights experience category is why. Airbnb said users booked 125 million nights of experiences in its second quarter results. As someone who's used it recently, once I was traveling overseas, I used it a decent amount. It does help, but I know a lot of locals aren't very happy with Airbnbs affecting their rental markets, and kind of understanding why. So their shares dropped 14% in after hours trading after the company reported second quarter earnings that missed analyst expectations. And here's how they did. So their earnings per share was 86 compared to the 92, and their revenue was just above at 2.75 compared to the 2.74. Revenue still increased 11% over the year, and Airbnb reported a net income of 555 million or 86 cents per share, down 15% from the 650 million or 98 cents per share a year earlier quarter. If you are an investor into Airbnb, you've probably been tracking this, but it is something I've kept my eye on. Not as something I'm going to invest in, but just one of those companies I like to watch. And I did know that they were doing, they did have an expansion stuff coming with new projects, and like they said, that nights and experiences. But it will be interesting to see if companies like Airbnb are affected by boycotts in countries like Spain and places like that who are not very happy with the rental market that they're experiencing for locals. Overall, also having a look through my portfolio and my Excel spreadsheet, you can see this is again another visual of how things are kind of weighted at the moment. Amazon's obviously taken up a bigger portfolio position now, and this is kind of how things have been trading for me over these months, like even over a year now, nearly 2 years. And again, this is just from the start of the month, so I've invested more. Both of these will continue to go up, but it's nice to see, even with these market downturns, with my constant investments, I can hopefully keep growing these, and I'm on the path to hitting $75,000, which will be a big goal of mine. Hopefully, if the markets decide they want to act nice and rebound a little bit, I can hit that next month. That'd be quite a big milestone for me on my way to $100,000, and I'll keep doing the videos tracking it. In regards with dividends, nothing new to report here, but my dividends will continue to grow, and then hopefully as these continue, as I buy these positions at this cheaper price and I get more shares, it means my dividends in the upcoming quarters will be growing as well, which I can reinvest, and that snowball effect kind of does its own thing. Overall, like I said, the portfolios are sitting at around just over $71,000, and there's been a bit of a big market pullback. My portfolio especially is down around 10%, I'd say, as of late, but I've had periods where I was in the negatives, negative 10, negative 20% years ago, so I'm not really too affected. If you really believe in the companies that you're investing in, you can probably see some of these opportunities as buying opportunities. But again, you need to do your own research and decide what kind of suits your risk appetite. So that's all for now, and then I'll do another video next or this weekend, just after I've done my investment today.